Welcome to vSkills YouTube channel. In this video, you will learn about the top interview questions for international trade and Forex. So, let's get started. Question number 1. What is the primary goal of international trade? The answer is: in general, international trade and the accompanying financial transactions are conducted to provide a nation with commodities it lacks in exchange for those that it produces in abundance. Also, such transactions, functioning with other economic policies, aim to improve a nation's standard of living. Question number 2. What are the types of international trade? The answer is: the three types of international trade are: first, export trade; second, import trade; and last, entrepot trade. Question number 3. How is trade classified? The answer is: trade is classified into two types, that are: first, internal or home trade; second, external or international trade. Question number 4. What are some of the benefits of international trade? The answer is: some of the benefits of international trade are: longer product lifespan, decreased competition, increased revenues, better risk management, and easier cash flow management. Question number 5. What do you understand by the theory of international trade? The answer is: international trade theories are different theories to explain international trade, such that trade is the concept of exchanging goods and services between two people or entities. International trade is then the concept of this exchange between people or entities in two different countries. Question number 6. What are the elements of international trade? The answer is: the 5 elements of international trade are: first, balance of payments; second, correcting a deficit; third, invisible trade; fourth, trade gap; fifth, exchange rates. Question number 7. Why is international trade considered so important? The answer is: due to international trade, the trading partners get the goods cheaper than they get otherwise, since every country produces those goods in the production of which it has to incur less comparative cost. Question number 8. What are trade barriers? The answer is: the trade barriers are imposed by the government by placing rules and regulations, tariffs, import quotas and embargoes. There are 4 types of trade barriers, which include import quotas, tariffs, non-tariffs, and voluntary export restraints. Question number 9. What type of risks are there in international trade? The answer is: some of the risks in international trade are: credit risk, foreign exchange risk, intellectual property risk, shipping risk, and ethics risk. Question number 10. What are the various factors that determine the size of gain of international trade? The answer is: the various factors that determine the size of gain of international trade are: first, nature of terms of trade; second, the difference in cost ratios; third, productive efficiency of the country; fourth, relative elasticity of demand; fifth, factor endowments and technological conditions. Question number 11. What are the drawbacks of free trade? The answer is: some of the drawbacks of free trade are: first, unrealistic policy; second, non-cooperation of countries; third, economic dependence; fourth, political slavery; fifth, unbalanced development; sixth, dumping; seventh, harmful products; eighth, international monopolies. Question number 12. What is trade policy and what are the different types of trade policies? The answer is: trade policy is set the regulations and agreements that control the imports and exports to foreign countries. The main types of trade policies are: first, preferential trade agreement; second, free trade agreement; third, framework agreement; fourth, comprehensive economic cooperation agreement; fifth, comprehensive economic partnership agreement. Question number 13. What do you mean by a quota system? The answer is: a quota system is meant to impose restrictions on a particular number of goods imported into a country. This system allows governments to control the number of imports to help protect domestic industries. Question number 14. What are the objectives of trade policy? The answer is: the objectives of trade policy focus on reduced protection, increased market access for exports, achieving a more outward-oriented trade regime and greater global integration, aimed at increasing economic efficiency, and export-led growth. Question number 15. What is the basis of international trade? The answer is: the basis of international trade is the diversity of economic resources in various countries. All the countries are endowed by nature with the same production facilities. Moreover, differences in climatic conditions and geological deposits also affect the supply of labor and capital. Question number 16. What is the concept of free trade? The answer is: goods and services can be purchased and sold across international borders with little or no government tariffs, subsidies, quotas or prohibitions to inhibit their exchange under the free trade policy. This concept is the opposite of trade protectionism or economic isolationism. Question number 17. What does the term Forex mean and who runs the Forex market? The answer is: the term Forex refers to foreign exchange. In simple terms, Forex trading is the trading in currencies from various countries against each other, like the US dollar against the euro. The Forex market is run by a global network of banks that is spread across 4 main Forex trading centers in separate time zones: London, Sydney, New York, and Tokyo. Question number 18. What is the spot market? The answer is: the spot market is where financial instruments like currencies, commodities, and securities are traded for delivery. Question number 19. What is a forward market? The answer is: in the forward market, the forward rate is a contracted price for a transaction that has to be completed at an agreed-upon date in the future. Question number 20. What do you mean by forward market hedging? The answer is: forward market hedging is a means to protect exposure in the forward currency, interest rate as well as financial asset markets. In the financial instrument markets, hedging can take the form of investing in hard currency securities. Question number 21. What is hedging and what are its types? The answer is: hedging is defined as an instrument to alleviate risks. Hedging corresponds to the essential purpose of insurance. However, what marks the difference between the two is that hedging is not concerned with augmenting profits but alleviating risks. Some types of hedging are: first, money market operations for currencies. Second, currency future contracts. Third, forward exchange contract for currencies. Fourth, money market operations for interest. Fifth, forward exchange contract for interest. Question number 22. Which is the best commodity for trading? The answer is: precious metals like gold, silver followed by crude oils, natural gas and many more are among the best trading commodities in the world. Question number 23. What is credit risk? The answer is: credit risk is defined as the potential that a bank borrower or counterparty ought to fail in order to meet its obligations in accordance with the terms that are agreed. Question number 24. What is import duty and export duty? The answer is: import duty is nothing but a tax collected on imports and some exports by the customs authorities of a country. It's the value of a good that usually dictates the import duty. And export duty refers to the charges that are imposed on the goods produced within the country. Question number 25. What do you mean by basic custom duty? The answer is: basic customs duty is the duty that is imposed on the value of the goods at a particular rate. Moreover, this duty is fixed at a specified rate of ad valorem basis. This had been imposed from 1962 and gets amended from time to time. Question number 26. What is an export license? The answer is: an export license is a type of document issued by the licensing agency. After getting this license, an exporter is allowed to transport his product to a foreign market. Question number 27. What is an IEC? The answer is: technically, an IEC is a 10-digit number that is granted by the Directorate General of Foreign Trade to any Indian entity willing to do international trade. Question number 28. What is a credit letter and who has to pay for the letter of credit? The answer is: a letter of credit is a letter from a bank that guarantees that the buyer's payment to a seller will be received on time and for the apt amount. The charges of the letter of credit are paid both by the applicant as well as the beneficiary of the LC. Question number 29. Who is the largest exporter of goods? The answer is: since 2009, China has been the biggest exporter of goods in the world. Question number 30. What are the factors in determining an export price? The answer is: some of the factors that determine export price are cost, demand, competition, attitude towards country's products, product differentiation and brand image, nature of purchase, quality and price relationship, delivery schedule and many more. For more such videos, subscribe to our channel.